Welcome to PIMCO Pod. In this episode, we discuss how rapid U.S. policy changes pose challenges for investors accustomed to a global financial system anchored in U.S. markets and assets. Stay tuned after the conclusion of the podcast for additional important information. Trade Wars and the U.S. Dollar by Mark P. Seidner and Pramal Dawin. As U.S. trade policy transforms, investors are grappling with the implications for the world's preeminent reserve currency. Announced U.S. tariffs aimed at revitalizing domestic manufacturing in the long run could first weaken the U.S. economy and rekindle inflation, casting a shadow over the U.S. investment outlook. As trade barriers rise, long-standing partners are reconsidering their economic ties with the U.S. and contemplating alternative alliances. With its protectionist policy pivots, the U.S. is giving investors worldwide an occasion to rethink long-held assumptions about the U.S. investment landscape. Witness the recent parallel slides of the U.S. dollar, U.S. equities, and the U.S. treasuries, a combination more often associated with emerging market, EM, economies. The U.S. has long enjoyed a privileged position, with the dollar serving as the global reserve currency and treasuries as the go-to reserve asset. However, this status is not guaranteed. If global capital flows into U.S. assets dwindle, it could point toward a more multipolar world with a diminished reliance on a singular reserve currency. Paradigm shift. For decades, the U.S. has operated on a model of consumption, importing more than it exports. The dynamic of U.S. consumers satiating themselves on an endless supply of cheap foreign goods and the resulting current account deficit creates a U.S. capital account surplus. Nations in the post-Cold War era, including allies bolstered by NATO security assurances, have been able to prioritize savings and investment over national security spending, often funneling dollars into American financial assets. These international capital inflows have bolstered the dollar's reserve status, a cornerstone of U.S. economic exceptionalism. With tariffs disrupting this balance, the financing of America's twin current account and fiscal deficits may become more challenging absent fiscal support as countries pursue greater economic and military self-reliance. The breakdown of long-standing global correlations could be painful for a global investor, who may be left wondering how many U.S. assets to own. A diminished policy safety net. The U.S. enters this period with historically high sovereign debt levels and inflation exceeding the Federal Reserve's 2% target. If U.S. companies are compelled to manufacture goods domestically, production costs will rise, resulting in diminished productivity and an inflationary price level shift. The Fed will have to chart an interest rate path that balances resurgent inflation expectations with dimming U.S. growth projections. Inflationary threats may compel the Fed to cut rates only if economic data signal a significant slowdown. Conversely, currency appreciation in other regions may alleviate inflationary concerns, allowing the Bank of Japan and the European Central Bank to adopt a more dovish stance. Investors have come to expect forceful government intervention during economic and market downturns. Today, U.S. fiscal support appears less likely, not by choice, but due to limited capacity for additional debt. This era of strained geopolitical relations could mean far less global policy coordination than during previous crises. Investment implications. U.S. markets appear to be mirroring dynamics of the U.K. and EM, characterized by steeper yield curves, a weaker currency, and a structural risk premium, higher compensation for holding a country's assets. A self-inflicted supply-side shock similar to Brexit has led to a stagflationary outlook. Lessons from the UK suggest that the U.S. economy may need to rebalance towards structurally lower growth and higher inflation in the absence of fiscal capacity. Having long benefited from the existing ecosystem, the U.S. may face hurdles as the global order evolves. For investors, the return of equity may soon take precedence over the return on equity, prompting a shift toward diversification and a stronger home country bias. Based on this outlook, here are some investment strategies. Underweight the U.S. dollar. The U.S. has the largest negative net international investment position, NIIP, financed by global capital. As this rebalances, the dollar may weaken. Overweight global duration, Europe, EM, Japan, possibly UK. Duration, a gauge of interest rate sensitivity that is typically higher for longer-dated bonds, is challenging to forecast in the U.S., but alternatives appear attractive. For more, see our April 2025 cyclical outlook, Seeking Stability. Favor trades that benefit from yield curve steepening. The shift from a global focus on economic efficiency to one emphasizing nationalism introduces a greater fiscal risk premium. Underweight credit. We expect a more significant divergence between investment-grade, IG, and high-yield, HY credit, as IG balance sheets remain more flexible and insurance companies continue to support IG credit, a trend unlikely to extend to HY. In a more multipolar world, there may no longer be a need for a singular reserve currency. Multiple options would be necessary to safeguard national security interests, ensure diversification, and deliver stable returns. Thus far, this is a self-inflicted wound for the U.S. The dollar has only recently begun to structurally weaken. Sentiment and market performance could quickly reverse with a commitment to more sustainable and predictable U.S. policies. Thank you for listening. That was Trade Wars and the U.S. Dollar. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be, and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.